I think we've had a pretty rough week.
Yep.
All things considered, starting Monday. It felt pretty good, I think, last week, the week before, with Powell speaking and kind of giving the bond market a little bit of cushion. And then Rich Clarida, I thought, gave a wonderful speech on Friday. Felt like we were kind of past this Fed is going to raise a whole bunch issue that caught the market by surprise, I think incorrectly in October, early October. But now we've kind of triggered something else, something that's got everybody worried about, whether it's global growth, whether it's retail, whether it's excess debt, too much triple Bs, all this sort of weighing, I think, on market psyche as we head into a very illiquid period. I think that's really the story.
Are you saying we're trying to talk ourselves into a recession?
I don't know if we're trying to talk ourselves into it, but we have the liquidity conditions to get ourselves a pretty decent-sized correction, even if the fundamentals don't justify it. And I think if you really step back and think about the fundamentals, we are at a 3.7% unemployment rate. We're at a 2% PCE inflation rate. It's about as Goldilocks as it could get from a macro guy's perspective. The Fed kind of told you they're not going to do anything crazy, even though maybe early in October it sounded like they might. So you have all that kind of percolating under the surface, but the market got triggered into something sort of really messy in October. They got nervous on bond yields, they got nervous on credit, and I think we're going to have to just kind of see where the chips fall. I don't know how far it has to go down, but these 10% corrections, they happen. They happen in bull markets. They happen in the 90s a lot. We had them in 97s. We had them in a bigger one in 98. We had big in 99. We had them in 2000 before we had any sort of major correction. So they happen during bull markets. We've had 2 of them this year. It's a little more than usual. And maybe that says we're coming closer to the end of things than we're at the beginning of things, but I don't think we're at any immediate end.
Kevin, what are your thoughts on this? I mean, how worried should investors be right now about the sell-off we've been seeing in stocks?
I think investors need to pay attention to it. Basically, this has been a harder year than last. Last year was a lot of confirmation of a bullish case. We had global growth improving, not deteriorating. You had a great story in terms of the tax cut that initially last year wasn't going to happen, then ended up happening. And investor enthusiasm for all this was fantastic. Coming into the year, sentiment was about as good as you could possibly see. But as we went through the year this year, we've got cross currents. Overseas growth is not great. United States looks good. But those are at cross purposes with one another. So ultimately, I think you've got a more complicated situation these days. And the interest rates now where they are, even if the Fed does one more in December and then stops, the return on a risk-free investment like cash is becoming more competitive versus what's available in equities. So I think all of this just creates more choppiness that we've seen throughout the year. Does it signal an end? No, I wouldn't say that. But I do think that you're later in the cycle, and investors probably ought to be looking at moving up the quality spectrum in their portfolios at this point.